Hey guys, welcome back to the channel. I hope everyone is doing well. So today's topic came from a kind viewer, so let's get into it. So Norman over here says, well, maybe you can tell the old story about how Wall Street is intolerant of some things. They will consume or eliminate the riffraff. I assume you're familiar with the process. So hopefully I'm answering this question, or I guess like this, maybe this was request properly. So how does Wall Street cull the herd? So basically, it's pretty simple. Wall Street, well, there's an old saying like money talks and BS walks. So that's basically what it is. So we're just interested in money, like any other business. Now, contrary to popular belief, there's a lot of like media, the news, movies. Sometimes they make us out to look like bad guys, and that's not always the case. Wall Street doesn't target you intentionally, and it doesn't target you personally. Because think about it, like most retail investor accounts are too small. But however, if you bundle them up, then there's like something worth going after. And this is where the bad news happens. Like sometimes even if you're not the intentional target, sometimes you wind up as a victim anyway. And then one thing to note is that like some firms they accept relative performance. So basically, if they compare their own like funds or one of their products against an index or against the peers, and then but other ones, I've worked for both, where like some people have really harsh targets. Like even if your department is overall profitable, you can still be let go and does have your department be dissolved or like merged into other ones. And just of course like a disclaimer, but Panda, you're just a fat, middle-aged, washed-up Wall Streeter, which is true. But that doesn't mean all my information is completely outdated. There's still some things that still carry on till this day. And in my opinion, I'm still better than maybe 90% of financial scam tubers. So yeah, I'm a scumbag, but at least I have like some redeeming qualities. So what is Wall Street's role? Well, it's easy. They separate fools from the money. And right now, there's a lot of money that needs separating right now because some of it is borrowed. I'm already starting to see like in various statistics that people are taking on leverage. Now, leverage by itself is not bad, but I think anytime you take it to like an extreme degree, that's when bad things happen. And this is why like there's a lot of option trading going on now. Now, you might think to yourself, well, options aren't leverage. Well, it depends on how you're using them, but I guess maybe that's a topic for like another day. So our primary targets are whale money. So like for example, like larger institutions when anytime they need to raise capital, like Wall Street investment banks, usually they underwrite debt, securities, IPOs, etc. So for example, like Reddit is a good recent example. This creates like a lot of hype around like that product, and of course like eventually Wall Street's just gonna like dump this onto like the public. So of course just be careful about overpaying on like the first week or so. And then the second next best thing is like high net worth individuals. Here we can offer like more so-called sophisticated products. So think of like maybe like certain hedge funds or like maybe like fancy investment products that try to keep like a stable value. My personal opinion, most of these products are overrated. They're sometimes they're not really that much better than what you can get from like a retail ETF, but that's just my opinion. And of course, there's those certain divisions have private banking, and they offer like special rates to customers. So, for example, if you have like a large balance, they'll offer you debt at like a lower cost than like what you can get from like the general public. And but now we have like more secondary targets, like they're like the mom and pops. So basically, you send like the B team, and they're generally less experienced. They create like these low effort products to cash in on low net worth individuals, aka the former middle class. And for certain Wall Street firms, ETFs are like the almost perfect product. If you think about it, they appear cheap. You have like recurring fees, And sometimes like you get like free social media marketing, like for example on YouTube and Twitter, etc. So this is kind of outdated though. Uh, the Wall Street mentality, you like when I was working there, it was very testosterone fueled trading. But over time, that's slowly changed to like more like safer, predictable cash flows. This is why ETFs are kind of exploding because it's just easier on like their investment banks and certain banks' balance sheets. And quant shops really changed the game after the great financial crisis from like 2008, 2009. Now, they were there prior to this, but then this is my guess is that this is when they start to really take off. It creates a mutually parasitic environment. Uh, and to kind of explain that, retail gets tighter spreads. So, for example, anytime you buy a stock, ETF, or option, or whatever, over time, I think some of the older traders will kind of agree with me on this. Like, the spreads right now are probably the best I've ever seen in my life. Back when I was like trading my first options or like even just like stocks, spreads were pretty ridiculous, and this is how market makers made like a bulk of their earnings. But nowadays, like high frequency trading, that changed everything. So basically now, like you see, like even for like certain options on like very liquid stocks, you notice like they're trading in pennies or maybe even like a nickel at most, and you can kind of thank like high frequency trading firms for that because everybody's trying to step over each other to kind of like compete to give you like the best price, and they make their money off of like the data that you generate from like the brokers, and then you also make it up in terms of volume because this helps like the machine learning algorithms. And also now you'll notice like some firms are kind of desperate for new sources of cash because in the past like it would be kind of ridiculous for like Goldman Sachs to offer like a retail banking product. Like for example, there was like that old, I don't know if it's still around. There was something called Marcus. I think it was like this co-branded product that they had with Apple. I don't know if they took it or put it under a new name or if it completely disappeared. And then you also notice like that Goldman Sachs has like ETFs. Charles Schwab has like ETFs. So this is like a new way to kind of just like generate more predictable cash flows for these firms. And then there's like some implications of this because like brokerages, you'll notice like most of them have kind of like consolidated because they're a very low margin business. You don't make that much money. You make most of your money from selling the customer trade information to high frequency firms, and also like now certain firms like they don't pay out that big of a balance on your available cash. And then there's also like a kind of like the risk in the future of like concentration of like the market making business, where in the future there's a possibility that if there was a some type of crash or some type of like severe financial event in the future it might get less competitive, but I'm hoping it doesn't get that bad. And then also like you'll notice like during like a maybe like a correction, spreads could expand at the worst possible time, so just watch out for that. Oops, sorry about that. uh, and then just continue on the implications. I don't know if this is completely related, but this is just like my theory. I think there's a societal effect on this as well. We're going from like at least in the US, we're going from like a nation of like stuff to fluff, meaning we used to have like a really strong manufacturing base, and now it's kind of, I feel like it's not as strong as it used to be, and I think part of it's just because like a lot of our like the STEM majors, so basically the science, technology, engineering, and math. Uh, Obviously, like if you're like for example like you're a Zoomer or like a younger millennial, and you're trying to just recoup like the your educational debt. So of course, like whenever like a Wall Street firm or like a big tech firm like they come calling, of course you're gonna like, well, you're gonna come work for like your big big tech, big finance, sugar daddy. So and that leaves like less talent for like real life engineering and infrastructure projects. I feel like this area is really underinvested, especially in like energy. And of course, like you well, depending on where you live, you might see like a lot of urban blight and like a lot of like just like shoddy roads, like dilapidated like buildings and things like that. And it's just it's a real shame. And don't be shocked if like plane parts fall out of the sky. I used to joke about this a lot, but now it's actually not a joke anymore. I mean, what the heck is Boeing doing? Like, I mean, it seems like every other day there's like some crazy mishap with our airlines, and sometimes in certain neighborhoods, like the lights literally go out. So I'm hoping like these are maybe I'm hoping it's temporary, but something tells me that it might not be. But anyway, back to Wall Street. So overall, I would say like going forward, I would say liquidity is king. So I guess like when the next 10% or more correction hits, take really good notes on like the bid ask spreads that you see on your bonds, stock, ETFs, or options. My guess is that the next bear market could get really fugly. So just to reiterate, just be careful out there. Don't be lulled into like a sense of complacency. So like for example, I still expect 2024 to be in an up year. Could get volatile, especially heading into like the election. So like around like October, November, you might see some crazy like price action. But then we'll probably end like the year on like a positive note. But then after that, is anyone's guess. And also like liquidity is also a hell of a drug. Just like back in my day, was not unusual for Wall Streeters to like unwind with nose candy. Uh, I guess I don't want to actually name what it is, but you can guys can figure out for yourself. Unfortunately, there's also like escorts and like crazy escapades at gentlemen's clubs. Now this and then the second part is more for like a for my own hearsay. So I don't have personal experience with like this next part. Now allegedly they prefer like different uh, things. Just because like the I think the competition is so fierce right now. People are resorting to like to performance enhancing drugs, stimulants, and open relationships. Now this is just from hearsay, so I guess like if you're also like a Wall Streeter, like a current Wall Streeter, maybe sound off in the comments to see if this is actually true or not. This is just like from like just like gossip. And then kind of like related to this, like there's a lot more competition amongst like retail traders and investors, and this is kind of like the side effect of like having a lot of liquidity. And I don't know how long this will last because like during a crisis people gotta like pull their money out. So I would suggest like well, and this is just like my personal plan too. 2024 should be like a really good year. This actually might be my last really good bull market, so I'm gonna try to take advantage of it as much as I can, because after that I don't know exactly what like where I can like place my money. But I'll keep you guys updated, I guess, like in the future when the time comes. And right now, I've noticed there's a lot of, I would say, like option-based ETF addicts. I think this is probably because of, I guess, like the competition, like from other like the normal ETFs, like it's not that great. You can either get like good total capital appreciation, but like capital appreciation, you have to like take your profits periodically. Whereas with like these option-based ETFs, there's a potential for good distributions, but I'm noticing that the effects are starting to wear off. Meaning like that, well, there's not really much capital appreciation with some of these option-based ETFs. I think the best that you can do is like kind of like manage to keep like their like the net asset value like steady. But again, time will tell. don't be surprised to see like further ETF liquidations as time goes on. And then also watch out for like low assets under management ETFs. So basically, again, like it's pretty simple. No money, no honey. So at some point there will be a flight to safety. So like for example, like the Roundhill products that were recently rolled out, like the XDTE and QDTE. Now so far, like the volume, like selfishly speaking, I'm glad they're not as popular, or at least not yet. I'm kind of hoping that they don't get too popular. I don't want like the yields from the distributions to get diluted. But I think over time, as the word spreads, like I think these products will get ruined as well. But that's just my opinion. And then also watch out for things that are like on the chopping block, because also like low volume products, they get less interest from market making firms. So then like your bid ask spreads could be horrible. So for example, triple QY, like so far, they, well, you can, depending on where your cost basis is, you're probably not too happy, but at least like the bid ask spreads are okay. Like for like to pay for an ETF, like the 3 cent difference between the bid and ask isn't too bad. And then also, like it's weird, like for like the option chains themselves, they're not, depending on like the day, they're not that great. Besides like the 16 put over here, like a bid ask spread of like 40 45 cents isn't like the end of the world. But look at like the, if you look at the call side, there's like no activity at all. And look at like the one at, for like the A expiration, like a bid ask spread of like 0 and 75 cents is, I mean, that's pretty horrible. But anyway, there was also like a recent a thing that I mentioned in a prior video called the ETF Death Watch. So I think like hopefully there will be more financial blogs like this, like that kind of keep track of like the ETF space. I don't have any affiliation, but I just found this to be like a useful link. So check it out when whenever you have the time. And then like the big guys definitely prune. So older established ETF companies, they routinely cull underperforming ETFs. So just be sure you're near the exits when the time comes. And then also, so YieldMax recently tweeted out something. So the short option income strategy ETFs are coming. So the inverse ETFs. So I think just to end this on a more positive note. So I think it'll be really interesting to see if they release these all at once. I'm hoping they do, just because I really want to do more analysis on this and see how they react in the wild. And of course, like I'm just gonna end this on like the usual risk. The expense ratios on some of these products are still relatively high. As usual, there's no control over option strike selection. Although I think the inverse ETFs could be interesting, we can kind of modify our exposures. The implied volatility, unfortunately has collapsed. Yields are not consistent month to month. And I think we're in PvP mode now, where like it's player versus player. And then eventually I think this is going to become predator versus prey. So be careful about that. But I think for 2024, we still have some time. If you like this type of content, please consider giving this a like. All subscriptions are welcome. So thank you for watching. I hope people make some good money out there despite the volatility, and I'll see you in the next video. Bye now.